Hello, folks. Welcome to this episode of Rich Insights. I'm Don Rich. Today's topic is bottom fishing. Are there any gems left? And the quick answer to that is no, right? We are essentially talking about searching for the least ugly pig at this point. But I do think there's one that is disproportionately more attractive than the rest of them, and that's the utility sector. All right, before we go through the reasons why, I just want you to consider, the utility sector and how would you go about investing in it? I would just think about taking a passive ETF approach to it, just a cap-weighted passive ETF. All right, why utilities? Well, we can see here based on the chart, the utilities are down essentially 5% year to date. Here as of the end of last Friday, right, August 7th. Utilities were down 5%. The S&P was up almost 4%. And, of course, NASDAQ up 23%. So we're talking about bottom fishing here. So I sort of confined my attention to those with negative year-to-date returns. All right, so let's be clear about that. I'm not anti-tech. Right? What I'm looking for here is sort of the non-tech trade. Where else is there some low-hanging fruit? Right? Where else is there something that might run up? Right? Other than the tech-related sectors. Okay. So out of these, again, utilities, real estate's down here, financials, and energy. Now, energy, you can see, is down 40%. Now, you're going to see from a number of the charts that energy looks dirt cheap. And it is. But it is a kahuna's trade. Boy, you got to have some big ones to go into energy. There's some good stuff about it. But again, we're in the midst of this greener movement, the greener attitudes. We know our energy consumption is going to continue to diminish over time. Right? So you got to factor that in. I think of energy as purely a tactical trade. Far less a strategic trade anymore. Now, one other reason for utilities, you can see last month. Last month, utilities had a big month, right? They rallied nearly 8%. So, yeah, I'm cheating a little bit, right? I'm chasing the ambulance here. I've been talking about this for a while. I like it. Now I got the tailwind. I got some tailwind with me. All right, so let's talk about the fundamentals. The fundamentals. Here's the EBITDA for the utility sector. And again, you can see it has just rolled over. It has just rolled over. The last, let's call it 6 or 7 months, it's just started to roll over. You're saying to yourself, hell, fat man, you always say, avoid the areas that are in earnings decline. Well, people, everything, or at least damn near everything's in earnings decline right now. Right? Some of them have completely collapsed. So the fact that this has just started to roll over is much better than a lot of the other sectors. Again, we're looking for the least ugly pig at this point here. All right. So again, that's the utility sector here. Just started to roll over. How does that compare with some of the other ones? Well, it's very similar actually to healthcare. Healthcare has also just started to roll over. It looks, pretty similar to it. Again, it's not tech. Tech is the one area that hasn't rolled over. Tech is still flying, right? Again, this is not an anti-tech suggestion. I'm talking about sort of a barbell approach, perhaps. You got your high beta tech stuff, and you might want to think about mixing that with some Utes. All right, so that's our tech sector. Again, the earnings profile for tech looks the best. The problem is it priced in? Now, is it priced in? On tech is expensive, right? It has the best earnings profile, but it is definitely priced in. Tech is expensive at this point. So let's look at some of the other charts to see, is it priced in or has it been priced in at this point? So here I just throw four of the, at least three of the lower beta sectors here. We have consumer staples, all right? You can see where consumer staples are at. So this is the cross price, or the relative price between the sector and the S&P 500. And you can see lower indicates more expensive S&P. So higher in this chart means expensive sector, lower means cheap sector or expensive S&P. So staples are sort of right in the middle. They're neither expensive nor rich. They are cheap relative to where they have been in recent times, but in a longer term perspective, they're sort of right in the middle. Utilities, you can see, again, cheap relative to recent history. And about the only time it was actually cheaper was following the 2001 recession here. All right, that's one of the reasons. Utilities certainly are not expensive. If we look at tech, the tech chart is going to be off the charts, right? It's at all-time highs. The real estate sector is also something to consider, but with so many people missing payments, with the eviction moratoriums, with the uncertainty of the COVID virus, I'm just not ready to put my big boy pants on and get into real estate yet. But Utes show some promise. Here's what I was talking about with energy. You say, can energy get any cheaper? Well, virtually every day it continues to get cheaper right now. This is the falling knife, right? This is the tough trade. This probably has the highest potential reward, but it also has the highest risk. Keep that in mind. All right, now what else? So the utility earnings growth is not being priced in, and the earnings growth, the EBITDA growth, still looks pretty promising. What do you get with utilities? Of course, you get lower beta. We're coming to the time of year we got to think about lower beta, right? We know we have a number of pullbacks this time of year. We know the month-on-month comparisons are going to start working against us. April, May, June, the tailwinds were at our back. Everything was pushing numbers higher. Now we're going to get to push the other way, going lower. So the low beta aspect's interesting. Also the high dividend. Okay, the high dividend aspect. You got to think about that, especially relative to where interest rates are at today, right? It is not attractive. Bonds are not attractive. So you got to look for these fixed income surrogates as a possibility here. So that's what we have on this chart here. We have earnings yield and dividend yield. All right, and we see here utilities. Utilities for dividend yield, let's start with the orange bars. Dividend yield, actually the highest, slightly higher than real estate, the highest outside of energy. Again, the energy companies, for the most part, have been trying to hold their dividends constant while their price collapses. And of course, that makes their dividend yields shoot off to the moon. These dividends aren't guaranteed. I can assure you the utility dividends are a hell of a lot closer to being guaranteed than the energy dividends. But again, if you want to try to catch a falling knife, the energy is probably the most extreme case. So utilities have that nice dividend yield. Look at the earnings yield with this bad boy. Oh my gosh, we don't need the Kardashian sisters to tell us. You put this combination together, boys and girls, that's not a bad cocktail now. Come on. All right, so that's our message for today. Consider the merits of the utility sector. My name's Don Rich, and you just experienced a Rich Insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.